Let's discuss the latest
Sure.
Fed headlines and what it might mean for markets and the economy. Joining us today, Wells Fargo Securities Head of Equity Strategy, Chris Harvey, and UBS Chief U.S. Economist, Jonathan Pingle. Guys, it's great to see you both. Jonathan, we got Manheim under our belt this morning, and I'm wondering if you're, or how you're thinking about CPI going into Thursday.
Oh, I mean, we think the Fed's going to get another kind of piece of good news on the inflation front on Thursday. You know, our expectation is that the core is going to rise 0.19%. So another rounded 0.2. And look like things are cooling. A little bit of a different mix of the components, but I think that the Fed officials are generally going to welcome that. It's going to help indicate that the June improvement was not a one-off. I mean, there are always reasons to caveat the data because it's noisy, but I do think this is going to fuel the soft landing narrative and be welcomed by FOMC officials.
Yeah. Chris, I'd like you to respond to that, sort of fold in what we've seen happen to commodities off of some of these one-year lows and how that affects your year-end target analysis.
So, Carl, I think that's right. I don't think we're going to get much from CPI. I don't think it's really going to change the equation. I think the big thing right now is what the Treasury did last week and the amount of issuance, the surprise issuance that they put to the market. And that's really roiled the rates market. We had the 10-year above 4%. We had it making a beeline to 4.25%, which was the cycle high. And I think that's the real story at this point in time. And until we see rates kind of calm down here, things could be a little bit touch and go. Nothing terrible, but you're going to have a lot more volatility because your all-in yields I'm not sure they're attractive enough to bring in those buyers.
Chris, just to be clear, is that volatility in the rates market in particular, or just the overall effect that it's had on equities? And do you expect to see more of an effect on equities in the weeks to come?
So, Leslie, there's been a fair amount of volatility in the rate market. I think that will continue. But really what I was focusing on was the volatility in the equity market. We haven't seen a ton of it. As we all know, it's late in the summertime. Earnings season is more or less over, or mainly over, and the macro begins to take over. So we could see volatility really start to ratchet up a little bit higher. And so don't expect, until you see rates begin to calm down, I don't think volatility in the equity market is going to calm down just yet.
Hey, Jonathan, going into the summer, a lot of equity strategists were trying to draw our attention to external events that might affect the market. At the time, it was debt ceiling. But I wonder if you're thinking about UAW strikes, overall fiscal tightening, government shutdown. That's getting mentioned a bit this week.
Yeah, I mean, Carl, we think about all of that, obviously, right? Given the spread between what's coming out of the Senate and the House, odds of a government shutdown are rising. We do think that the resumption of student loan repayments will be a meaningful headwind for a wide range of households. And we are expecting the recent debt ceiling agreement to at least limit the expansion of federal government spending over the course of the next year. So, there are some headwinds coming up as we roll through the end of the year that could be pretty meaningful. We'll also have to see whether or not the slowing we're seeing in the labor market, as much as it might be hawkish, as Steve was saying, there are reasons to think if that continues to slow, it does risk slowing too far, and that kind of momentum and support for consumer spending waning as well. But we're certainly not out of the woods on some of the external influences on the U.S. economy, and the global backdrop has not looked particularly great lately.